How can I not remember that after 18 years? Oh, well. Anyways, so the focus today is on inflation, the durability of the current inflationary trend, and the risks and opportunities posed to investors. We'll provide a brief historical view of inflation and its cause, with a focus on the 1970s. Finally, we will assess the potential risks to financial assets. The trend in inflation has been altered into an upward trajectory, which will likely pose a significant risk for investors. By examining the quantitative inputs of inflationary drivers, it is easy to believe that the trajectory of the inflationary trend may be strongly upward and durable. With inflation, stocks in general will struggle. Additionally, if the Federal Reserve decides to be aggressive in dealing with inflation, a bear market will occur as a result.
Right, and investors will likely achieve the highest risk-adjusted returns by using a tactical management mentality in their investment allocations, no matter the scenario, and focus on areas of the market that will benefit from if inflation should unfold the way we expect, which is what we do. We move in and out of the market based on the risks that we see. And, you know, what we've done, we used to have a very broad spectrum of stocks, and that was good for that time. Now we've gone to a more limited portfolio, and we are targeting the areas that are doing well in inflationary times. So, you know, I encourage you to take a look at your portfolios and make sure that you're just
that you understand what you're in.
We're going to talk more about that later too. Anyway, governments and central banks will likely begin to deal with the underlying factors that have built this strong inflationary foundation. Perhaps even more concerning to investors are political pressures allowing the inflationary structure to snowball. That is what occurred in the 1970s until Volcker lowered the hammer. If central banks want to allow inflationary pressures to continue, it could cause an extended period of negligible returns for the major asset classes. If central banks become too aggressive than the market prefers in reducing money supply, it could cause a significant bear market. In either case, it is a challenging environment for investors and not an easy task for the Fed either. So let's give you a little background on history, and we'll try not to bore you to death in this, but there are commonalities behind each of the three periods of hyperinflation during the last century. In 1914, when World War I began, inflation was 1%. By the end of the late 1918s, inflation was over 20%. And then the Spanish flu began in February of 1918. The United States saw a drop in the ability of supply goods and services to consumers, but at the same time, an expansion due to the war's demand. What happened after the war and the Spanish flu is fascinating. A period of negative GDP growth during the Depression of 1920 to 1921. Inflation fell to negative 11% in 1921. To follow was the Roaring '20s, which was a great period of economic growth driven by innovation and big productivity. Second was the World War II. Inflation shot up to 10% in 1941 and fell back down to 2 to 3% in 1943 to 1945, and then had a second wave, peaking the year after the war ended with inflation at 18%, which was in 1946. During the war, the United States had the most command-like economy the country has ever seen, boosting war production and skyrocketing GDP. GDP crashed. The GDP crashed after World War, and then during World War II, the economy put in place a sizable amount of production capacity, leading to a couple of decades of growth with low inflation.
So the most significant period of inflation occurred in the 1970s, with the foundation put in place in the latter half of the 1960s, but it was exacerbated in the early 70s. In 1964, President Johnson implemented a major social spending plan called the Great Society, while concurrently needing to fund the Vietnam War. Do you see a trend in any of this stuff that we're talking about? In 1966, inflation began accelerating. By 1970, inflation was over 5% annually. After these inflationary policies began, the price-earnings ratio of the S&P 500 in 1968 was about 18 times earnings and bottomed in 1982 around 7.5 times. When inflation began to take hold in the 60s, the yield on the 10-year Treasury was around 4% and peaked at about 15% in 1981. In 1971, the United States completely severed the link between the dollar and gold. transitioning to a full fiat currency. The Federal Reserve maintained an accommodative stance as Nixon influenced the Fed to pump even more money into the economy. The Arab oil embargo began in 1973, in which oil prices increased tenfold from 1970 to 1980. Inflation from 1970 to 80 averaged a whopping 7.9%, increasing in waves, and finally peaking in 1979 at 13.3%, which is the year I graduated from high school, and I had no idea this was going on.
Well, I just saw my parents, buying off brands and, cutting back on some of the expenditures, and I heard them complaining about gas prices.
Yeah,
So,
I don't remember any of that because, anyways, I lived on a farm. I guess we were kind of insulated because we had all our own food.
Right.
There's an economic theory called the Phillips Curve, which stated there is an inverse relationship between unemployment and the inflation rate. So as the unemployment rate drops, the rate of inflation rises. The Phillips Curve was largely misused in the 70s because of the incorrect assumption that the inflation rate and unemployment rate always have an inverse relationship. This was clearly shown not to be true.
Mm-hmm.
During a period of stagflation in the 70s, policymakers pushed for higher inflation in aims to reduce unemployment. Nonetheless, high unemployment continued. Policymakers did not understand the Phillips curve. Clearly, lower unemployment can cause higher inflation because you have fewer people working, and so it takes more effort to get anything done.
Right.
But higher inflation does not lower unemployment. It had the opposite impact, and this was a major policy mistake.
Yep.
Federal Reserve Chairman Paul Volcker later went on to kill the inflation previously created by misguided policy by aggressively raising interest rates. The Fed funds rate was raised to the highest rate in U.S. history at nearly 20%. The cost was higher unemployment, sending the economy into twin recessions in the late 70s and early 80s.
So, inflation is simple. It's created because supply and demand get out of balance. A supply shock or simply supply not growing can cause prices to rise. The other cause for inflation is demand pull, which occurs when consumers have more money or demand, which outstrips the existing supply, which is what we have today. A rapid expansion of money supply by the central banks or government deficits cause money to find a home in the purchase of goods and services or investments. An economy that is effectively incentivized through low tax rates, less government regulations, or other government hindrances can expand supply to minimize inflation from too much money printing. When inflation heats up, it is generally because of too much monetary or physical stimulus without the needed increase in productivity of an economy.
So the monetarist theory created by Milton Friedman is expressed by the formula. Oh, you were going to read this one.
The monetarist theory created by Milton Friedman is expressed in the formula MV equals PQ, where M is the money supply, V is the velocity or average number of times the money is spent in a year, P is the price of the goods or services, and Q is the quantity of goods and services in the economy. This means that Q is also the same as real GDP. So PQ equivalent to nominal GDP equals MV. Now, if you look at this formula on a piece of paper, it's M, the money supply, times V, the circulation per year that dollar circulates in the economy, equals to the price per unit times quantity. In the short run, the value of all four factors may change. In the long run, the velocity of money and the quantity an economy can produce does not change too significantly. Over a longer period, the frequency of purchases is relatively consistent as the amount of real GDP can increase. Historically, the average is 3.3 annually, which is why economists view V and Q as relatively constant. Essentially, this means that prices need to increase when money outgrows the economy's ability to meet subsequent increases in demand.
The trend of inflation and interest rates has trended downward for around 39 years and has clearly hit a bottom. During the past roughly 20 years, inflation has been modest, fueled by the slack in production capacity driven by technological efficiencies. The United States The United States' steady economic growth can be attributed to an advancement in technology, allowing a moderate expansion in quantity produced, while simultaneously keeping P, price, stable. With the maturity of the Amazon economy, which was an advancement of disruptive technology providing goods at lower prices, along with newer constraints, the trend of inflation is clearly higher. Through history, we had other periods of great Q, quantity produced or productivity growth that finally ends due to government interference. Alternatively, it is swallowed up by too much stimulus or demand. If adjustments are not made now, inflation may persist for an extended period.
All right. So let's talk about inflation today. The economy experienced the effects of a supply shock due to COVID, and that has created the foundation for a significant inflationary cycle, significant inflationary cycle has been established by shrinking the production capacity of the economy and fueling demand with a tsunami of money expansion. In the beginning of COVID-19, the United States experienced a supply shock. Initially, the aisles of the grocery stores were empty. No toilet paper could be found for months, and many essentials were just not available. Total demand for goods expanded due to consumer panic buying the available goods. Both employers and employees that were working were overstretched with this higher demand, especially because there was not enough workers willing to work in the riskier COVID environment. To compensate the increase in demand, companies had to increase wages, attempting to increase the amount of employees willing to help businesses manufacture, transport, or restock inventory. The wage increases returned the economy to a more efficient state, just with higher prices. The result of the supply shock and the need to remake the economy has caused a long-term uptick in inflation.
So over the course of the following months, the government forced many businesses to shut down due to lockdown restrictions. This gave rise to a huge unemployment surge. As businesses that survived were able to open back up, the worker had been able to dictate higher wages. However, many workers have chosen not to re-enter the workforce.
That's right.
This has caused a significant shortage of labor along with a diminished benefit of productivity. Jamie Dimon, CEO of J.P. Morgan Chase, came out this week and said people actually have a lot of money and they don't feel like going back to work. So I have a story of a nurse that I know of through a client, and they say that she works 3 months and makes so much money that she takes the next 3 months off.
Right.
And then she works another 3 months when she feels like it, and then she takes another 3 months off.
And we have a friend that's of ours from the military. As a nurse, she moved to North Dakota and is making $150,000 every 3 months.
Wow.
I mean, it's crazy. But you know, I've read articles recently where they're talking about the savings of the U.S. Consumer that is high, but they do see the trend that is going down, and that's going to help the quit rate. And right now, the quit rate is in January it's 2.8%, February it was 2.9%, and in March it was 3%. So you see a constant uptick in this, but those
people
numbers,
quitting their jobs because they want to.
Right, and they're quitting, but they're not necessarily going and getting on the unemployment rolls. So when we start seeing the savings that people have, you know, sitting off to the side, going down, and they're going to start coming back to work. So this quit rate should drop. The unemployment problem has been largely generated by the major failure of Congress adding funds to unemployment benefits and holds to mortgages and student loan repayments, which I saw this week that Biden canceled a bunch of student loans.
That was for a rotten college, though.
Oh, was it?
Yeah,
okay.
It wasn't just general. It was, and that's something they've been working on for years because people got ripped off going to these rotten schools that overcharged them for garbage degrees.
Degrees where they couldn't get a job.
Right.
Yeah. In some cases, this made it so that workers were making more money on the unemployment than they would be by finding work. This resulted in employee wages becoming more elastic, which is employees were not as attracted to the wages due to the government providing other means. And employer wages becoming more inelastic, which is employers paid what they had to pay to get employees to come work for them. There were even more COVID relief programs that further vexed the problem, bringing the money supply to insurmountable levels.
So I've got to tell you about this individual that I know. She was retired. She's a widow, and she came to see me. And she said that a friend called her. The friend was running a restaurant, and she said, "Hey, this is before COVID. Can you come work for me 2 days a week? I just need a hostess 2 days a week." And she's like, "You know what? That'll be good for me to get me out of the house and do something. And I'll help you out." So she starts being this hostess 2 days a week, making waitress server wages. I don't think the word waitress is appropriate anymore, right? You're only servers. Hostess? Well, she's going to be a hostess. She's paid like a server. Anyways, so she works 2 days a week. and then COVID hits, and then they shut everything down. She got full, even though she was choosing to only work 2 days a week, she got the full state and the full federal unemployment, which I think was like $600 a week, more money than she'd ever made in her life. And she got that money all the way through the shutdown, and then when they opened the restaurant back up, because she chose to only work 2 days a week, she stayed on it because of her income level. And so she got the state and the federal for 16 months until they finally shut it down.
And we had people in the automotive garage that they literally came in as a group and said, hey, we're willing to come to work, but just tell the unemployment office that we're unemployed right now. Because
they were making more
money
being unemployed.
That's right. So, but also exacerbating that problem was the EIDL and the PPP, which just added more money to the economy.
It just got thrown around without even confirming people actually needed it.
That's right.
And then as soon as the unemployment ended, Biden rolled out the whole child tax credit, getting it early. So instead of waiting until you file your tax return, you started getting a check in the mail based on how many kids you had.
That's
and you got half your child tax credits that last half of last year. So all of that money has been piling up on people, and then they just filed their tax return and got the other half of it this year. And so that's why Jamie Dimon is saying people have too much cash, they don't need to go to work. And it's our government has created this problem. So long-term employment has shrunk, causing a decrease in the total amount of output the country can produce. There is no longer any slack within the system. A 38% increase in money supply has caused total demand in the long run to increase significantly. This huge injection increases price quite significantly. We could see higher than normal inflation to continue for a long time because quantity is only able to increase an average, and that's quantity produced, is only able to increase an average 2 to 3% per year, whereas price could adjust much more rapidly to compensate, which is exactly where we are.
Right, and Sherri, you mentioned money supply, and if you hear the terms M1, M2, and M3 in articles or on the news, here's what they mean. M1 is the sum of currency held at depository institutions such as commercial banks, savings and loans associations, savings banks, and credit unions. Okay, go ahead.
M2 is M1 plus savings deposits, small denomination time deposits, and retail money market mutual fund shares. And then M3 is a collection of the money supply that includes M2 and everything.
Okay.
So, the effects of increased money supply. Similar policy mistakes are occurring now as in the 1970s with excessive money growth. From 1970 to the end of 1979, M3, which is the broad money supply, expanded by 150%, or an average annual rate of 15%. Productivity growth slowed due to inflationary pressures and could not offset the aggressive expansion of monetary policy. The M supply M1, which is institutional, has increased 406% from January 2020 to November of 2021. From the beginning of 2020 to October of 21, we saw M3, which is the broad money supply, increase 38%. These are extraordinary expansion rates. If money expands by 38% in the formula MV equals PQ, it is impossible for the Q, quantity produced, to increase at a rate to compensate for P, price per unit, or inflation has now begun.
That's right. And in terms of real GDP, the economy is up about $250 billion, or 1.3%, from its peak at the end of 2019 to the end of the third quarter of 2021. But the economy is probably trying to just offset the enormous increase in the money supply by an increase in prices, which just tends to it's just starting to show up in the economy right now, Sherri. The Federal Reserve nor the government leadership will accept the pain needed to kill inflation until it becomes a bigger problem, and we see that all the time. The result of the central bank's massive stimulus and money printing was something truly unexplainable, with $18 trillion in bonds with negative yields. These central bank policies have created a bubble of all bubbles in the bond market, and a negative absolute return on a bond that an investor holds to maturity should not exist.
So I'm seeing folks that are coming to see me, prospects to look at their portfolio, that have bond funds that are down 12 and 14%, and I've never seen this before. It's bad. So we stopped out of our bond funds a long time ago.
But they're not bad forever. So we'll eventually, when the ground is right, we'll go back in.
So the Federal Reserve's balance sheet has expanded by over 100% since 2020, up approximately $4.5 trillion. And I read yesterday it's actually $6 trillion now, which equals about 20% of the size of the U.S. economy. That is a problem. The federal fiscal deficits during the past 2 years have been averaging about $3 trillion per year. These deficits are staggering relative to any other time period. The deficit has been averaging roughly 15% of the economy, which is historically extremely high, another example of aggressive money supply.
Yep.
So is this an inflationary cycle or an aggressive Federal Reserve policy shift? Inflation rose 7% in 2021. The Federal Reserve has maintained the Fed funds rate at near zero, but has recently started rising interest rates in a plan to shrink their massive balance sheet by the end of this year. The U.S. federal budget deficit is expected to be $1.66 trillion in 2022, which is 7.5% of our economy, a very inflationary policy. Energy costs are a very important ingredient into all goods. With the massive push to green energy, it is not prudent for an oil company to approve any long-term exploration. Energy costs could rise much higher than expected as supply falls, and they're calling it $200 a barrel. It's already $120 yesterday.
That's right. I'm reading a lot of articles that are calling for $200 a barrel.
And I mentioned this before, but the U.S. oil producers responded to Biden's request that they turn on the spigot, like he doesn't know how this works. And they responded in an article in the Wall Street Journal about 6 weeks ago, I think it was, as a unified voice saying, we're actually business owners, and we actually have to make money to produce oil, so it's going to be a slow process. As we make money, we can increase production, but it'll take them about a year. And so, I mean, it's not...
This is not a one and done, get it, just flip the switch today and make it happen. But the problem, too, is that with the new green energy mentality in Washington across the board, and I get it, I love to save the environment and everything, but, when you have crises like this, you need to work with the people who can solve the problem, and they don't seem to be wanting to do that.
Right.
Which is probably why Biden was heading over to Saudi Arabia. And
Yeah, and then that canceled that trip because it looked pretty bad. The Federal Reserve currently expects inflation to be 2.6% in 2020. And if you're wondering whether I like Joe Biden, I think you know. Just in case you're wondering. However, we are seeing the circular relationship between inflation and higher labor costs. The Federal Reserve cannot wholly control inflation without extreme measures. The deficit is a very big problem, along with our domestic energy policy. The trend in energy costs do not appear to be slowing. If the Fed wants to kill inflation, they can by shrinking the money supply via shrinking their balance sheet, the M in the monetary theory. The analogy of this is like chemotherapy. It works, but it will also kill most everything else with it. In the short term, that would be very bearish.
All right, so what are the scenarios that might play out? Well, there's probably more than three, but here's three. First, the Fed does not do enough to significantly reduce the inflation. Even if inflation moderates to 4 to 5%, it will take a long time for the Fed fund rate to go even above 3%. The result is inflation will remain elevated. The Federal Reserve, the federal government will need to push to expand productivity by reducing regulations and incentivizing low-cost energy production. This is not likely to happen during this administration. Second is the math could be wrong about the magnitude of the inflationary cycle for some odd economic events that we do not currently see. And the labor participation rate could improve meaningfully, alleviating some of the wage price pressures. The Federal Reserve may slow the economy.
But that could take till the end of the year.
That's right. The Federal Reserve may slow the economy enough that inflation moderates. Interest rates may stay relatively low for the extended period, and perhaps it is flat to slightly negative quarter of GDP growth, enough to cause a significant market correction. And lastly, the Fed takes an aggressive approach by simultaneously increasing interest rates and shrinking their balance sheets. Under this scenario, there may be a significant bear market. All three require investors to reposition their portfolios. The risk in both the stock and the bond market are high. A significant decline in the stock market would likely quickly feed on itself because of the wealth effect, as such a high percentage of individuals are invested in speculative securities.
Yeah, which we can't talk about.
Right.
Tactical investing is made for volatile markets. So value and small cap companies tend to benefit as prices rise, as they are generally in industries that can pass along price increases. Growth stocks benefited greatly from a low inflationary environment and have valuations that are excessive. Given the low level of yields of high quality bonds, they likely will perform poorly as interest rates ratchet upward. Real estate will have the same headwind, but because of rising commodity prices and wages, real estate could be a good investment after an initial adjustment. So understanding what you're invested in is extremely important.
Why don't you tell them who we are first?
So you've been listening to Your Money on AM 940. We are Randy and Sherri Goss with Rosenberg Financial Group. Let me see what I'm supposed to say here. I have a script I'm supposed to follow. So we provide retirement planning advice and manage our clients' investment accounts. If you can't listen live to the show, you can always visit our website, retirerelax.com, and listen to the recordings and check out our special reports. We offer complimentary consultations. That actually is true. It really is complimentary. And we don't chase you into the parking lot trying to get your wallet. Anyways, check out our special reports on our website. Get a free consultation. And we have 2 programs that are coming up that you need to know about. It's about understanding Alzheimer's and dementia. We're sponsoring it. The Alzheimer's Association is going to be presenting, and they're both on Friday, June 17th. One is going to be in Warner Robins. One is going to be in Macon at the Wellness Center. So please attend, because I am seeing a lot of this. My father, as I mentioned at the beginning of the show, had it when he turned 91 and started making some major financial mistakes. My brother had to take over his bank account, and I see it in my office, and which is why I really like knowing the family. I like knowing the family so that if something shows up, I could reach out to the family and say, hey, you need to come to the next review because we got to talk about what's going on here. So anyways, email me at support@rfmoney.com if you want the flyers for the program.